In December 2001, the Houston energy titan Enron filed for bankruptcy. This was America's seventh largest corporation, named by Fortune as the most innovative company in the country 6 years running. Yet behind the glass towers, Enron was a house of cards. Billions in debt were hidden off the books, and the reported profits were largely fiction. One day Enron was a Wall Street legend. The next, it was gone. Enron was born in 1985, when Houston Natural Gas merged with a pipeline company called Internorth. Under its founder, Kenneth, it began as a quiet operator of natural gas pipelines stretching across the country. But Lay had a far bigger vision. Through the 1990s, the company pushed beyond pipelines into electricity, water, and even internet bandwidth, reinventing itself as something Wall Street had never quite seen before. The man who reshaped Enron was Jeffrey Skilling. He argued the company should not just own power plants and pipelines, but trade energy like a bank trades money. Enron would buy and sell contracts for gas and electricity, taking a cut on every deal. It was a bold, asset-light idea. And to make the numbers shine, Skilling pressed for an accounting method that would later help bring the whole company down. In 1999, Enron launched Enron Online, the first internet platform of its kind for trading commodities. Suddenly, the company was at the center of thousands of deals a day in gas, power, and dozens of other markets. To outsiders, it looked like the future of business itself. Enron pioneered futures and derivatives for electricity and natural gas, and investors were dazzled by its big bets and entrepreneurial flair. By the year 2000, Enron's fortunes peaked. It reported roughly $63 billion in assets and a staggering $101 billion in annual revenue. Investors drove the stock toward $90 a share in August of 2000. On paper, employees were getting rich, and Enron was ranked the seventh largest company in the United States. The chart was a near vertical line, and almost nobody asked how it was possible. Fortune magazine was mesmerized. 6 years in a row, it crowned Enron America's most innovative company. The firm collected energy industry awards and lectured others on vision and leadership. On the surface, Enron's executives preached ethics and creativity to anyone who would listen. Behind closed doors, a very different game was already being engineered, one built on illusions instead of earnings. Kenneth loved to talk about integrity. In 2000, he signed off on a polished new code of ethics, promising honesty and respect. Yet senior managers were quietly exploiting every loophole they could find. Inside Enron, transgressions were tolerated as long as they kept the money flowing. The high-minded values printed on company letterhead could not hide the deals being struck in the shadows. Enron pushed its own people to believe. The company encouraged every employee to load up on Enron stock and match their retirement contributions with more of the same shares. By the middle of 2001, around 2/3 of employees' retirement savings were tied up in Enron stock. The culture urged ordinary workers to bet their futures entirely on the company's endless rise. The deception started with the rules of accounting themselves. Enron embraced something called mark-to-market accounting. When it signed a long-term contract, it could book the entire expected future profit immediately based on its own optimistic forecasts, even if the cash would not arrive for years, if ever. In a rising market, it looked legitimate. In reality, Enron was stuffing its income statements with profits it had never actually earned. On paper, Enron grew larger every quarter. In reality, many of those profits were pure illusion. The company booked a $600 million gain on a power plant deal that never truly delivered. It inflated the value of new ventures and quietly funneled its losses into entities that sat off the balance sheet. And its auditor, Arthur Andersen, kept signing off on the books even as they filled with manipulations. At the heart of the machine was the chief financial officer, Andrew Fastow. Beginning in 1999, Fastow created secret partnerships with names like LJM1 and LJM2. Enron sold assets into these partnerships at inflated prices, sweeping debt and losses out of sight. Fastow sat on both sides of the deals and personally earned tens of millions of dollars. In effect, Enron was paying its own finance chief to cook its books. In 2000, Fastow built another layer of the illusion. a set of entities nicknamed the Raptors. Their purpose was the same: to absorb Enron's losses and keep them away from the eyes of investors. With each new structure, the gap between Enron's glowing public image and its rotting finances grew wider. Billions in real liabilities were now buried inside a maze that almost nobody fully understood. Inside Enron, at least one person saw the danger clearly. On August 14, 2001, a vice president named Sherron Watkins sent a confidential memo to Kenneth. She warned that the company's accounting was a disaster waiting to happen, that there was a very, very large hole in its finances, and begged that someone simply look at it before it was too late. Passed the memo along, but management largely brushed her off. On that very same day, August 14, 2001, the chief executive Jeffrey Skilling abruptly resigned, citing personal reasons after only months in the top job. To insiders, the timing was chilling. The architect of Enron's trading empire was walking out the door just as the cracks were starting to show. Kenneth stepped back in to run the company, insisting to the public that everything was fine. Then the numbers Enron had hidden began to surface. On October 16, 2001, the company announced a $1 billion after-tax loss for the third quarter, its first loss in 4 years. Days later, it admitted slashing more than $1 billion from shareholder equity after unwinding some of Fastow's off-book deals. With every reluctant admission, the stock fell further, and the questions grew louder. On November 8, 2001, came the admission that shattered what was left of investor trust. Enron announced it would restate years of earnings, from 1997 through 2000. With a single filing, hundreds of millions of dollars in previously reported profit simply vanished, cutting past net income by $569 million. The message was unmistakable. The Enron the world had believed in had never really existed. As the scandal spread, Enron's own board scrambled to respond. At the end of October 2001, it formed a special committee, led by an outside expert, to investigate the tangle of related party deals Fastow had built. Regulators at the Securities and Exchange Commission had already begun asking pointed questions. The machine that had run so smoothly for years was now being pulled apart, piece by piece. Outside the company, the doubts hardened into alarm. Analysts who had cheered Enron for years now demanded answers that never seemed to come. Each evasive reply, each delayed filing, told the market the same thing: something was deeply wrong. The stock that had touched $90 a share was sliding toward the ground, and a company once worth tens of billions was running out of time. Desperate for a lifeline, Enron agreed in November 2001 to be rescued by a smaller rival, Dynegy, in a deal valued at around $9 billion. For a few days, it looked like Enron might survive. But as the true scale of its losses kept emerging, Dynegy walked away. With the rescue gone and the credit markets slammed shut, Enron had nowhere left to turn. The collapse was breathtaking in its speed. A stock that had traded near $90 a share at its peak was worth about 26 cents by the end of November 2001. Tens of billions of dollars in market value evaporated in weeks. Retirement accounts, college funds, and life savings tied to Enron stock were being erased in real time, with nothing the people who held them could do. On December 2, 2001, Enron filed for Chapter 11 bankruptcy protection. It listed around $63 billion in assets, making it, at that moment, the largest corporate bankruptcy in American history. Trading in the stock was halted. The empire of energy trading that had been celebrated on magazine covers just months earlier had imploded almost overnight, leaving behind only debt, lawsuits, and disbelief. The human cost was brutal and immediate. Nearly 25,000 Enron employees lost their jobs and their health benefits almost overnight. Many had followed the company's advice and poured their retirement savings into Enron stock. Now those accounts were worth almost nothing. Workers who had felt wealthy weeks earlier suddenly faced an empty future, watching the executives above them escape with fortunes already banked. The damage to ordinary families was staggering. Employees lost an estimated $2 billion in pension savings and more than $1 billion in other retirement funds, because so much of their $401 money had been locked in Enron stock, many saw decades of careful saving wiped out in days. For thousands of households, retirement simply disappeared, replaced by anger and a desperate search for someone to blame. The wreckage spread far beyond Enron's own walls. Banks, suppliers, and power companies that had extended credit or done business with Enron lost money when the bills went unpaid. Pension funds and mutual funds that held its stock saw their values collapse, dragging down everyday investors who had never even heard of Fastow's partnerships. Enron's failure shook confidence in the honesty of corporate America itself. The public outrage was impossible to ignore, and Washington moved fast. By early 2002, Congress and federal regulators were dissecting Enron's collapse from every angle. Executives were summoned before televised hearings, where some answered questions and others refused to speak at all. Prosecutors assembled a special task force, gathering thousands of boxes of documents and chasing every lead through the rubble of the company. In February 2002, an internal investigation known as the Powers Report laid out the truth in cold detail. It concluded that Enron's managers had generated false profits and hidden the company's real debt through the web of special partnerships. This was not a case of bad luck or a market downturn. It was, the report made clear, a deliberate machine built to deceive investors, regulators, and the company's own employees. As investigators closed in, Enron's auditor made a fatal choice. At Arthur Andersen, one of the largest accounting firms in the world, employees shredded a mountain of Enron-related documents and deleted emails. It was meant to bury the evidence. Instead, it handed prosecutors a clean and damning charge and turned a story about accounting into a story about obstruction of justice. In March 2002, federal prosecutors charged Arthur Andersen with obstruction of justice for destroying those documents. The firm was convicted, and although the Supreme Court would later overturn that verdict on a technicality in 2005, it no longer mattered. Clients had already fled, and Andersen, an institution with roughly 28,000 employees in the United States, had effectively been wiped out by its ties to Enron. The man who built the hidden partnerships became the government's most important witness. In 2004, Andrew Fastow pleaded guilty to fraud and agreed to cooperate, receiving a reduced sentence of around 6 years in exchange for his testimony. His account helped prosecutors reach the men at the very top. One by one, Enron insiders, accountants, and traders cut deals or faced trial, admitting their roles in the fraud. In May 2006, the reckoning reached the top. A jury convicted Jeffrey Skilling on multiple counts of fraud, conspiracy, and insider trading. Prosecutors described him as the mastermind who had tolerated deception to keep Enron's stock price high, while ordinary employees were told to keep believing. The architect of the trading empire was now a convicted criminal, facing more than a decade behind bars. That same month, the company's founder, Kenneth, was also found guilty of fraud and conspiracy. He had insisted to the end that he was innocent, but the jury disagreed. Then, in July 2006, before he could be sentenced, died of a heart attack. Because he died while his appeal was still pending, his convictions were formally vacated, an ending that left many of his victims without the justice they had waited years for. By the time the prosecutions wound down, nearly 24 people had been convicted in connection with the Enron scandal. Executives, accountants, and traders received prison sentences and fines. The task force pointed to those convictions as proof that white-collar crime would not go unpunished. But for the thousands of employees who had lost their jobs and pensions, no verdict could ever return what the fraud had taken from them. Out of the wreckage came a lasting change to American business. In 2002, lawmakers passed the Sarbanes-Oxley Act, tightening the rules on corporate accounting and forcing executives to personally vouch for their financial statements. Auditors faced new oversight, and the casual tricks that had let Enron hide billions became far harder to repeat. The scandal had reshaped the rules for every public company in the country. Enron's name became shorthand for corporate crime, taught in business schools and invoked in every scandal that followed. A company once celebrated as the future had become a grim warning. Its rise was built on a simple, seductive lie that profits could be conjured from forecasts and partnerships that the numbers would always go up. When the truth finally arrived, it took with it tens of thousands of jobs and one of the most admired companies in America. Enron promised a new kind of company, one too innovative to fail. In the end, it proved an old truth instead, that a business built on hidden debt and invented profit cannot stand forever. The trades were unwound, the executives convicted, and the savings of thousands were gone for good. The most innovative company in America turned out to be its most elaborate fraud. Case closed.